Is Hong Kong destined to be the major ship finance center in Asia? It is well known that since the global financial crisis of 2008 until 9 and the ensuing recession, the shipping industry has suffered heavily from overcapacity of ship and insufficient demand for cargoes, leading to downward pressure on vessel values and earnings. The offshore sector continues to be hurt by the drop in oil prices to the extent that many rig owners will struggle to find funds for recommissioning or face the scrap yard alongside hundreds of their support vessels. The KG system of financing ships in Germany has been annihilated, forcing their banks to reduce their lending budget and take over defaulted ships. Some have had no choice but to sell off their loan portfolios or close down. European owners have gradually lowered their market share from 47% till 45% of the global fleet. Although Asian owners have suffered too, and headline bankruptcies like Senko Steamship, STX, TMT, and Hanjin Shipping are proof of this, the number of loan enforcement has been comparatively small. The majority of owners in Taiwan, Singapore, Japan, China, and Hong Kong were able to call on their institutional and private shareholders to provide working capital. They delayed or paid small penalties to cancel their new building programs. They didn't seek public equity through IPOs and shipping funds, preferring to retain control of their asset. They sold off or scrapped their old tonnage, and they cut back expenditure to the bone. Never wants to seek market domination by mass ordering, having learned valuable lesson for the recession of 1985. Their traditional method of replacing tonnage only when demand required and generally subject to a period charter party has proved that prudence or owning with banking characteristic does work. Consequently, Asian owners have increased their market share from 38% to 40%, of which PRC owners now control 12%. The PRC leasing companies are competing to grow further, and 20% isn't an impossible target. Current thinking. Lenders are aware that the contraction in shipyard capacity has helped to rebalance the supply or demand ratio. The consolidation in container ship owners has reduced speculative ordering, and that values and earnings have either bottomed out or are starting to recover in the dry bulk, container, and oil sectors, albeit choppy at times. Despite this background, the appetite for ship lending this year remains cautious. Every bank is analyzing whether to remain in shipping or to sell its portfolios and warehouse vessels into a rising market. Debates are raging in-house between risk compliance, corporate, and commodity department about the technical complexities of ship finance, fluctuating earnings, volatile values, the cyclical spike and trough. Added to this are the ongoing risks of obsolescence for non-compliance with environmental legislation designed to reduce shipping carbon footprint, low profitability, and, perhaps most serious, the high-risk weighting of ship mortgage and long-term loan for capital adequacy purposes. Sign of positiveness. To counter these perceived difficulties, there are signs that banks can see as a window of opportunity, especially in the Far East. Global seaborne trade is experiencing steady annual growth and is forecast to grow further by 3.6% year on year in 2018. New building and refinancing are expected to require 80 until 100 PN US dollar. There is a huge market demand, and Asian banks have found. The lending climate in 2018 is very different from the previous 5 years. There is less competition from European, UK, and Scandinavian banks. The private equity funds have realized that charter hire rates are not nearly enough to reach their expected return on equity, so have turned their attention toward buying bad debt portfolios from banks rather becoming owners themselves. This presents an opportunity for ship lenders to increase their market share with the possibility of higher margin and fees. The leasing market has grown substantially in Asia, particularly in China. This can be seen as beneficial to Asia, especially Hong Kong and Shanghai, by providing a type of Tier 2 support for vessel values. The reason for this is because their shareholders are either financial institutions or state-owned enterprises, which make their forced exit from this sector for financial reasons unlikely. Similarly, the competition from PRC banks who are lending to these lessors can be seen as beneficial because of their balance sheet strength and their contribution to the development of sophisticated financial services and products. The combination of PRC lessors and banks presents an opportunity for Hong Kong to become a major ship finance center in Asia. Under the 13th five-year plan, the PRC government has expressed support for Hong Kong to become an international transportation center, in tandem with a separate scheme to promote Shanghai as a world-class maritime center. Both schemes create opportunities for the two cities to complement each other and to generate more business, and not just from China's Belt and Road Initiative. Out of a total of 13 maritime cities, Shanghai now ranks 4th and Hong Kong 7th, and banks with branches in both cities may find synergies between their customer bases. The HK Trade Development Council has been raising the profile of the shipping sector for some time, but other business groups are now speaking from the same page. Recently, the HK Financial Services Development Council (FSDC) has suggested that the tax incentive would encourage greater competition by Hong Kong companies in the region, and particularly compared with Singapore, which continues to draw business and manpower away from Hong Kong. A precedent has already been set in 2017 in the aviation sector by an amendment ordinance that reduced the rate of profit tax for qualifying aircraft lessor and leasing managers. If a similar tax reduction is introduced for the ship leasing sector, Hong Kong could see sizable office being established in Hong Kong PRC leasing companies. The more economic activity in Hong Kong, the easier Hong Kong can refute OECD claim that base erosion and profit shifting to low tax jurisdiction like Hong Kong is a harmful tax practice. In addition to tax incentive, the FSDC has proposed to the HK government that more support for shipping banks and their financial products should be provided by establishing a sovereign rate financial institution or export credit agency.